To keep yourself updated, subscribe to IndigoLearn and click the bell icon and download our app OneFin to start learning on the go.
Friends, so before we proceed further with problems, there are two key concepts that I want to very specifically highlight to you guys, right? One is called hedging, another one is called arbitrage. Hedging and arbitrage. I might have mentioned it in the earlier chapters, what is hedging and what is arbitrage, but it makes sense for us to revise or rehash or recollect what we mean by hedging and what we mean by arbitrage. First, let us look at concept of hedging. Okay, if you remember, I given you examples of brinjal, then gold, variety of examples I had given to explain to you what is a future, what is a forward, so on and so forth, right? Now, if you were to continue the same brinjal example and see or understand what we mean by hedge in a purely, logical and arithmetic terms. Arithmetic means number terms, okay. So, I am taking a brinjal example of a normal futures contract, okay, brinjal example for futures, and I will try to explain to you what a hedge is, okay, or how does the hedge play out. Now, imagine that, you need 1 kilogram of brinjals on 31st of December. You are today on 1st of January, you need to buy 1 kilogram of brinjals on 31st of December of that year, okay, you have 1 year gap. Now, let us say, on the day on 1st January when you are starting, or the day when you enter into the futures contract, the price of brinjal, let's say, is 100 rupees per kilogram, and depending on the concepts of futures, forwards, depending on the market conditions, so on and so forth, on 31st of December, you believe, the market quotes a price of 130 and you are also okay with that 130 because, you are a price taker, you are like, okay, chalo, let me go ahead with this 130. And what you do is, even though today's price of brinjal per kilogram is 100 on 1st of January, the future price, the price for future which is deliverable on 31st, which is deliverable on 31st of December is at 130. You enter into a buy contract. Buy meaning you go long or buy mean the same thing. That is, you agree to buy 1 kilogram of brinjals on 31st of December at 130 rupees for brinjal that is trading at 100 rupees today. That is, today it is at 100, on 31st December it will be at 130 and I agree to buy 1 kilogram on 31st of December. You enter into a contract like this. Fair enough, very simple contract, it's just a piece of paper, correct? Now, on 31st of December, let us say that, the market price is 200 rupees, correct? Market price for brinjal 1 kilogram is 200 rupees. Then, what happens is, you will go and say, Dekho boss, I have purchased I have gone long on a contract, I have gone long on brinjal futures for 1 kilogram. And that 1 kilogram is deliverable at 130 rupees. Please give it to me at 130 rupees. Okay. Now, what happens? If you remember, I also told you something about cash settlement and, actual delivery and so on and so forth. Now, the party with whom you enter, okay, let us say you enter the agreement with some farmer, okay, one farmer, Mr. Sham, okay, you had entered into contract with Mr. Sham, a farmer. Now, this gentleman says, Dekho, see, I also don't have actually brinjals right now. I cannot give it to you at, 130. Whatever brinjals I had, I sold off in the market or I don't have the crop or whatever the case may be. But I will honor your contract. So, what that person will do is, Mr. Sham will give you the net difference between 200 and 130. What is this 200? What is 130? 200 is the spot price on the settlement date. And what is 130? 130 is your exercise price or contracted price. He will say, see, I cannot give you brinjal at 130. Instead, I am going to give you 70 rupees, which is the difference between today's spot and the contract price. You take this 70. Anyway, you were supposed to give me, that is, you were supposed to give Mr. Sham 130. I am giving you additional 70. You were anywhere supposed to spend that 130. Now, there is 70 that I am giving you. You combine both of them, please go and buy in the market at 200 rupees. Did you understand what I said? Anyway, you, the student, were supposed to buy it at 130. So, there was a definite cash outflow of 130. Mr. Sham, who is the farmer, says, I have entered into a loss-making contract and I am making good my loss. I am giving you my 70 rupees, whatever is the loss on the contract. You take it. So 130 what you were supposed to anyway spend, and the 70 rupees whatever I am giving you, combine both of them, make it 200 rupees, go and buy in the market at 200 rupees. This was what we understood as a simple forward or future contract, right? Now, in this, there was a genuine need. There was a genuine need for the student, that is you who are the student, on December 31st to buy 1 kilogram of brinjal. Okay, and you entered into a contract such a way that on that day, on the end day, your eventual prices, your eventual cash outflow is 130 only. How is cash outflow 130? You agreed to pay 130. The 70 came in and went out. Right, 70 was not your money, 70 was the profit that came in and it went out again. So, you added the 70 plus 130 and you actual cash outflow was 200 for you. So, you entered into a transaction, on 1st January knowing that you wanted a price of 130 on 31st of December, where you crystallized your cash flow of 130. Whatever is the excess or shortfall, okay, if the price is higher, then Mr. Sham will give you 70 rupees. Which is what our current case was, correct? If the price were lower, exactly opposite would have happened, okay? Either ways, your price of 130 is frozen. Now, when you say that your price is frozen, what does it mean? It means that you have hedged your 1 kilogram requirement of 31st of December of that year at a price of 130. You have hedged your 1 kilogram brinjal requirement on 31st of December at a price of 130. You have hedged this on 1st January. So, on 1st January itself, you took a set of actions whereby you crystallized and you hedged your total outflow. You did actions, you entered into contracts, you entered into a future contract such a way that your outflow on 31st of December towards 1 kilogram of brinjal is frozen at 130 only, because if market, even though market price is 200, somebody else gave you 70 rupees, you combined that with your original outflow of 130 and paid in the market 200. So, your net outflow on 31st of December is frozen at 130. Now, this concept, this is same as future what we discussed, but the key thing what I am trying to highlight in this concept is, you have hedged. Hedged means you have an exposure. On 31st of December, you have a requirement. You were aware that you will have a requirement and you entered into a contract to crystallize the price of that requirement on 1st January itself. Okay, this is called hedging. Now, I gave you a very simple example by means of brinjal. So, friends, after having understood, very conceptually what this hedging is from a brinjal perspective, which is, probably only to give you a logical understanding, let us take a real life example. Let us talk about India's biggest imports, which is petroleum. Let us take example of Bharat Petroleum, BPCL. Now, BPCL, let us say, has imported petrol. Okay, they have imported some crude from some Saudi Arabia or some place, and they are supposed to pay that Saudi Arabian supplier after 2 months. Okay. They have imported some petrol worth, let us say, $1 million. $1 million, okay, and they are supposed to pay that supplier $1 million after 2 months. Please bear with me with respect to this foreign exchange introduction, because in the next chapter also we are going to discuss foreign exchange only. But now I am trying to help you understand what is this meaning of the word hedging by taking this foreign exchange example, okay. Now, so they have to pay $1 million after 2 months. And they have to pay it in dollars, okay. Now, rupee dollar exchange rate is today 75, okay. After 2 months, what will the exchange rate be? Nobody knows, only God knows, nobody knows. Exact number, nobody knows. But what they can do is, they can go and approach Citibank. They will say, dear Citibank, after 2 months, I need to, make a remittance of $1 million, okay. I don't have dollars with me, so I will need to buy dollars from you. Okay, I will buy dollars from Citibank after 2 months. Instead of buying dollars after 2 months, let me enter into a contract wherein I agree today itself that I will buy dollars from you after 2 months, and let us decide on the rate now itself. Let us decide on the rate now itself. So, PPCL goes to Citibank and says, let me enter into a contract, in forward contract, okay, wherein on that day, after 2 months, okay, from today, let us say today is Jan 1st, on 28th February. On 28th February, I need dollars from you so that I can give the dollars to my Saudi Arabian supplier. I need $1 million. Today the price of rupee dollar exchange rate is 75. On that day, I don't know how much it will be. Let us agree on a price now itself. So Citibank says, okay, based on the formula, some formula of how the rupee dollar exchange rates are determined and all of that, they will say the price will be not 75 rupees. Price, let us say, will be 80 rupees. I know 80 rupees is a very large number, from 75 to 85 rupees difference, but I am trying to round up the numbers. Okay, just go with the flow. So Citibank will say, oh, so you please, if you want me to deliver dollars to you, if you want me to give you dollars on 28th of February so that you can pay them to your Saudi Arabian supplier, you have to agree at a price of 80 rupees, even though today's price is 75. Now BPCL will say, okay, let me agree. BPCL may say, okay, I will agree. Now million means how much? Million means 10 lakhs, correct? So what BPCL will do is, okay, I enter into a contract with Citibank to buy $1 million, that is 10 lakh dollars at 80 rupees each, okay, on 28th of February of that year. This is entered on 1st of January. Now, come 28th of February, let us say the dollar price is not 80, but let us say it is 85. Okay, I am taking an extreme example. Dollar prices move to 85. What will BPCL do? Please think logically. BPCL says, boss, I have already entered into the contract, so I don't care what happens. My price is 80 only. I will buy from Citibank dollars at 80 and give those dollars off to my Saudi Arabian supplier. Okay. But let us say Citibank says, no, I cannot give you dollars. Let us do a net settlement of cash. What is this net settlement of cash? Just like in Brinjal example where I gave 70, which is difference between 200 and 130. Same logic applies here. Citibank says, I am supposed to give you at 80. Okay. $1 million at 80. But now, for whatever reason, I don't have $1 million. So instead of giving me $1 million, the exchange rate today between rupee and dollar is 85 versus the agreed rate of 80. So let me give you 5 rupees per dollar. So $1 million into 5 rupees. $1 million into 5 rupees. You will get 50 lakhs. So Citibank will say, take this 50 lakhs. Million is 10 lakhs, right? So 10 lakhs into 5 rupees. How did you get 5? 85 minus 85. So 10 lakhs into 5, 50 lakhs. 50 lakhs, Citibank will give it off to BPCL. Now what will BPCL do? BPCL will go to the market, because Citibank did not have dollars, they will go to SBI and say, dear SBI, please give me $1 million. SBI will say, today's market rate is 85, please pay me 85 per dollar. Okay, so 1 million into 85, 10 lakhs into 85 is how much? 8.5 crores. So BPCL will pay SBI 8.5 crores, okay, and get $1 million. And this $1 million BPCL will send to their Saudi Arabian supplier. Okay, so far so good. Now what has happened? SBI has taken 8.5 crores, but BPCL has got 50 lakhs from Citibank. So 8.5 crores minus 50 lakhs is how much? 8 crores. What is this 8 crores? 1 million, which is 10 lakhs into 80, the pre-agreed price. 10 lakhs into 80 is 8 crores. So BPCL's liability is crystallized at 80 no matter what the price is. So instead of 85, let's say the market price is 90. Let's say the rupee dollar exchange rate is 90. Then Citibank, instead of giving 5 rupees per dollar, will give 10 rupees per dollar. So they will give them 1 crore. What will SBI say? SBI will say, instead of giving me 8.5 crores, give me 9 crores. So SBI will ask for 9 crores. So this 9 crores will be outflow for BPCL, 1 crore will be inflow for BPCL. What is the net flow? 8 crores. So what have they done here? BPCL has hedged their position. Hedging means stopping or minimizing or reducing or putting a limit on the price that you will pay or the risk that you will take. It is stopping, mitigating, putting a limit on the price that you will pay or the risk that you will take. So here they have hedged. Who? BPCL has hedged, HEDGED, hedged their risk of currency fluctuations by entering into a forward contract at 80 rupees on 1st of January for $1 million when the payment was due on 28th of February. They entered into this contract with Citibank. Citibank didn't have dollars. They did net cash settlement, gave them the money, and using that money and their own resources, they purchased fresh dollars from SBI, and then those dollars they sent to their Saudi Arabian supplier. Now you see what has happened. BPCL has very, very clearly hedged their position by entering into a forward contract, with Citibank, right? So, why is all of this relevant? Why is this whole currency example relevant? Why is this, brinjal example relevant? When we are talking about futures and options, one of the biggest or rather most important functions of futures or options is they help you to hedge your risk. Let us say you have a large portfolio. Okay, you have 1,000 crores of stocks. Okay, you are very sure that today Nifty is at the peak. Okay. You have 1,000 crore worth of stocks. You are supposed to, liquidate all these 1,000 crores after 2 months. Why? You have a huge project, power plant you are building. For that you need 1,000 crores, but you need it after 2 months. You don't require it today. Can you sell it off today? Don't know. But after 2 months, definitely you require. So what you will do? You will go and enter into a futures contract. What kind of contract? Exactly what you want to do. So what will you do? Let us say today is 1st January and you want to sell everything on 28th of February. You will say on 1st of January, you will enter into sell future contract. That is, you will sell. Notionally, you will sell this entire shares at 1,000 crore today itself. Okay. And say on that day, I will deliver to you all these 1,000 crore worth of shares at 1,000 crores on 28th of February. So no matter what happens to the market, you have already ensured that your sale proceeds are 1,000 crores. And I told you about this MTM and all of that stuff, right? So on the eventual 28th of February, when the eventual delivery has to happen, contract matures and all of that, you do a net settlement. Why? Because on 28th of February, whatever these equity crores which are worth 1,000 crores on Jan 1st, you will sell them in the market on 20th of February, whatever the rate that is. But you also have sold some futures on the exchange on 1st of January. Right, what will happen for these futures? You will have a net settlement. So let us say on 28th of February, index has gone up by 10%. So what happens to your portfolio? Portfolio which was 1,000 crores is now 1,100 crores. So when you sell it in the market, you will get 1,100. But you also have sold a future. No. So on future, you will make a loss. On future, you will make a loss. Why will you make a loss? You agreed to sell to somebody at 1,000 itself, but the market on that day is 1,100. So that person will say, please give me, that difference of 1,100 and 1,000, please give me 100. So what you will do is you will pay off 100 here, you will receive 1,100. So 1,100 minus 100 is 1,000. Ulta happens. Let us say the stock market falls by 10%. From 1,000 it falls to 900. Then what will happen? You will sell these entire stocks in the market at 900. Okay, but what has happened here? You have entered into a futures contract. You have entered into a sell future where you agreed to sell to somebody at 1,000 crores. Now that other person will say, Arey, I have to still buy from you at 1,000 crores even though the value of this is at 900 crores. So let me give you the net difference. Whatever is my loss, 100 crores, I will give it off in cash to you. So that person will give you cash. So you've got 900 cash here, you've got 100 cash here. So both become 1,000 crores together. So if the Nifty goes down, you make 900, 100, 1,000. If the Nifty goes up, you make 1,100 minus 100, which is again 1,000. So either ways, once you have entered into a future contract which is exactly equivalent to the value of your exposure of this 1,000 crores, you have hedged that particular exposure for that specific time period of 2 months. So this is why you need to understand what is hedging. We are going to see problems about hedging as we move further into this chapter. Okay, I wanted you guys to understand what is hedging. Hedging is you do actions wherein you are entering into contracts, futures or forward, of what exactly is your eventual end goal. That is, if you have to sell your portfolio after 2 months, you will enter into a future contract today itself to sell. Or if you have to buy dollars from somebody after 2 months, you will enter into a buy dollar contract today itself, right? And these contracts are cash settled, and the cash settled money either comes in or goes out, and your eventual contract, these two are independent contracts. That is, you buying dollars from SBI is very different from your cash settlement from Citibank. Same way, your futures loss or gain on Nifty is a completely independent contract from what you sell in the market on 28th of February. Okay, so you'll have two sets of contracts. One is a futures contract, one is a main contract. The gain on loss on both of them are set off, and you will realize the net value. Okay, so this is the concept of hedging, wherein you crystallize your either inflow or outflow. In case of this 1,000 crores, it was an inflow. In case of BPCL, it was an outflow. You crystallize either inflow or outflow today itself. This process is called as hedging. It can be done using forwards, it can be done using futures, sometimes it can be done using options also. Okay, we have understood hedging. I told you there are two terms I want you to understand. One is hedging, second one is arbitrage. What is arbitrage? Arbitrage basically means buying something in one market at cheap rate and selling something in another market at a costly rate almost instantaneously or at the same time or at the very, very small gap of time. Let me give you an example. Okay, very, very simple example. Let us say, I don't know exactly how Delhi's topography is, but I am just giving you an example. Let us say there is a direct train from Noida to Gurgaon, okay, direct metro. There is a metro from Noida to Gurgaon, or it will take you, you have to change in Rajiv Chowk and then somehow go somewhere. Finally, you will figure out that there is, within 2 hours you can reach from Gurgaon to Noida. Okay. Now, in Gurgaon market, let us say tomatoes are selling at 100 rupees. In Gurgaon, tomatoes are selling at 100 rupees a kilo. In Noida market, let us say tomatoes are selling at 120 rupees. Same kind of tomato. Okay. So, what you do? You become very smart. You go Gurgaon market, buy them at 100 rupees, buy 10 kilograms at 100 rupees, come board the metro, assuming metro people allow you to enter into the metro with that, big gunny bag. You will board the metro, take a ticket for, some 20 rupees or 30 rupees, then board from Gurgaon, then come to Noida. And in Noida market, we said they were selling at much higher rate, right? So, you sell whatever you purchase at 100 rupees, you sell thereof at 120 or 130, whatever the rate we decided, whatever the rate we said in Noida market. You go and sell it off in the Noida market. Morning you buy, you carry it forward in within 1 hour, you incur some expenditure of 20-30 rupees, whatever is a very, very minimal expenditure or negligible expenditure, and you sell this, 10 kilos of tomatoes in the Noida market at a profit. Now, what have you done? You have purchased something in one market where it is cheap and sold something in another market which is costly, where it is costly, almost instantaneously at very, very negligible costs of transactions, and you have made money. This process is called arbitrage. This not only works, not only if the product is same, but product is, one product is derived from other or one product is linked to other. Let me give you an example. Same tomato example. Okay. Let us say you make tomato sauce. Let us say 1 kilogram of tomato costs you 100 rupees, but 100 grams of tomato sauce, let us say, costs you 200 rupees. What is this logic? You buy 1 kilo of tomatoes for 100 rupees, you make a sauce out of it. The cost of sauce is very minimal, add some preservative or something, hardly 1 rupee, 2 rupees, and you will get 100 grams out of it. You purchased it for 100 rupees, but eventual output is 100 grams. So, your cost of tomato sauce is same 100 rupees, but you can sell it in the market at 200 rupees. Very, very negligible. You will probably incur 1 rupee, 2 rupee, 3 rupees, some extra cost, but you can sell it in the market at 200 rupees. So, you are making a profit, right? So, assuming that you can do this instantaneously, that is, when the day you buy tomatoes and the day you sell tomato sauce, there is no change in prices, everything is constant, or you have entered into transactions in such a way that you have entered into a forward contract for sale of tomato sauce today itself, right? Why am I saying all of this? Because the day you buy tomatoes, next day, let us say the tomato sauce price falls. What will you do? You will not be able to do anything, right? So, you thought that 100 rupees I bought, I made a paste out of it, I should be able to sell this paste at 100 rupees, but market is 200. Suddenly the tomato price falls from 100 to 50. Then tomato sauce price also falls from 200 to 100. Then you made a loss, right? Or you have not made any gain. So, assuming that you are able to buy tomatoes at 100 rupees and at the same time you enter into a forward contract with somebody to sell tomato sauce at 200 rupees, you have made a gain, right? Why? You purchased at 100, processed it, cost of processing is 10 rupees. So, 100 plus 10, 110, you sold it to that person at 200 rupees, you made a profit of 90. This kind of process where you buy in one form, sell it in another form, there also you can potentially make arbitrage, right? By doing some value add, holding it or doing something. Why have I explained now this logic? Because in stock futures market, sometimes when there will be some mispricings, that is, if you remember the formula F is equal to S into e power RT, which is the price of the future should trade at a price which is equivalent to S into e power RT. Let's say future is trading at a different price for no reason. Suddenly it is trading at a different price. You can make a gain, no? How? by buying the spot, then delivering it on that day, or buying or entering into kind of transactions like what I explained for you for this tomato and tomato sauce. You can do such kind of transactions also, no? Future is also based on the same stock. So existing spot price also based on the same stock. So can you not do some kind of arbitrage where you say that, you know, I will deliver it at a later date at a fixed price, and today I will buy it at a fixed price, and I will lock the profit, and from that profit I will subtract the interest cost, and then I will get some net profit. Yes, you can definitely do. We were actually going to be seeing some problems on that very shortly. Arbitrage is you buy something in spot, then you hold to it, you have the cost of interest, so you add the interest cost, then you sell it in on a later date and you get a higher realization. So the difference between whatever you sold after adding interest and the eventual realization is your profit. So there will be cases, we will see some problems where there is an arbitrage possibility also. Just like you buy tomato, make it a tomato sauce, add only 10 rupees and then sell it off in the market at 200 rupees when your cost of purchase and processing is only 110 rupees. Like that, there are possibilities in stock markets where you buy the spot and you sell it at a future date and you actually make profit. Why? Because the future prices are mispriced. Future is quoting higher than what it ideally should be. So you buy the spot, keep the stock with you, you lose some interest on that, or you have some interest related costs, you bear all of those, and then you eventually dispose of based on a future contract where you can actually make money. So we will discuss all these kinds of problems, right? So you've understood what is hedging and what is arbitrage. Fair enough?